Gold crashed 9% in a single day. Silver, 33. Today we'll understand why it happened, who caused it, and why it changes nothing. Hi, I'm Joe. Instead of giving investment advice one person at a time, I decided to just record these videos. My goal? Help you build generational wealth, old European style. Let's get into it with today's video. So let's start with what actually happened last Friday, because the scale of this move was genuinely historic. Gold dropped about 9% in a single session. Silver, and this is the wild part, dropped 33% in one day. Platinum, palladium, copper, aluminium, all got hammered. We're talking trillions in market value evaporated in hours. Now, the headline trigger was Trump nominating Kevin Warsh as the new Fed chair. Warsh has a reputation as an inflation hawk, someone who'd keep rates high and wouldn't run the money printer. And the market logic went, if the new Fed boss is hawkish, then the whole debasement trade, buying gold to protect against dollar destruction, is suddenly less attractive. So people sold. But here's the thing. The size of the crash tells us way more about market plumbing than about gold's fundamentals. Let me walk you through the mechanics, because this is important for understanding why a 9% gold drop does not mean gold's bull run is over. When an asset shoots up quickly, it attracts what professionals call tourists, leveraged speculators, momentum chasers, people trading on borrowed money at 10-to-1 ratios. Silver was absolutely packed with these guys. So when the Warsh news hit, silver cracked first. And here's where it gets mechanical. When silver drops 10%, the prime brokers, the banks lending money to these speculators, automatically start liquidating positions. Not just silver positions, everything. The broker doesn't care about your thesis. It sells whatever is most liquid to get its money back. That triggers the next round of stop losses, which triggers the next round of forced liquidations, chain reaction. And then the algorithmic funds, the robots that trade correlations between gold and silver, platinum and palladium, they pile on with short positions on gold because silver crashed, so gold must follow. The result? A 9% drop in gold that has almost nothing to do with gold's actual story. Morgan Stanley's quant desk estimated $3.5 billion in forced selling of silver ETFs and $650 million in gold ETFs in a single day. Silver's move was a minus 13 standard deviation event. For context, that's the kind of thing that's supposed to happen once in, well, basically never. Okay, so let's talk about Kevin Warsh, the man who supposedly killed the gold trade. The mainstream narrative is simple. Warsh is a hawk. He'll keep rates high, dollar stays strong, gold goes down. And I'll be honest, within weeks, although I am a bit late, you're going to see every bank analyst and finance influencer pushing targets of $2,500 gold or even $1,650. Same thing happened in 2022 after gold peaked on the Russia-Ukraine news. UBS had a $1,650 target. That turned out to be the perfect buying opportunity. But here's what the mainstream gets wrong about Warsh. First, this guy is not Paul Volcker, not even close. Volcker was a genuine power broker who worked with the Morgans and Rockefellers. Warsh is a well-connected son-in-law. His father-in-law, Ronald Lauder, the Estee Lauder billionaire, basically lobbied him into the job. Stanley Druckenmiller helped too, but let's be real about the primary channel here. As Paul Krugman put it, and I'm not usually a Krugman fan, but he nailed this one, Warsh is an inflation hawk only when there's a Democrat in the White House. Second, look at what Warsh actually said recently. He criticized the Fed for not cutting rates fast enough. He argued that AI would create deflation, so rates should come down. He called for massive reform of the Fed, including shrinking the balance sheet while also cutting rates. How you do both at once? Good question. Nobody has a clear answer. Third, and this is the key, Trump picked Warsh not for his ideology, but for his loyalty. Trump literally said at Davos that past Fed chairs told him what he wanted to hear to get the job, then raised rates anyway. He called it disloyalty. With Warsh, Trump is betting on the opposite. Someone who'll theoretically push back, but in practice do what the White House needs. So we have a Fed chair who criticized rate policy for being too tight, who believes in AI-driven deflation fairy tales, who was installed by his billionaire father-in-law, and who was chosen primarily for personal loyalty to the president. That does not sound like the second coming of Volcker to me. So, now here's where it gets really interesting. And this is the part you won't hear from anyone else. Ronald Lauder, father-in-law of the new Fed chair, Estee Lauder heir, president of the World Jewish Congress since 2007, major Republican donor, and, this is the fun part, the man who originally convinced Trump to try to buy Greenland. This isn't conspiracy theory. The New York Times reported in 2022 that the whole Greenland idea came from Lauder during Trump's first term. Quote, "My friend, a very, very experienced businessman, thinks we can get Greenland," Trump told his national security advisor. That friend was Lauder. And Lauder didn't just suggest it and walk away. He set up a Delaware-registered investment consortium called Greenland Development Partners. He put a former Deputy Secretary of State in charge. They bought stakes in Greenland companies. They're bidding on hydroelectric projects. This is a full-scale economic annexation play, running parallel to Trump's political pressure. And The Guardian reported, just look at that face, reported that Lauder is also part of a consortium pursuing access to Ukrainian mineral resources, which, let's just say, adds some interesting context to the Ukraine peace negotiations. Now, the question that matters for your portfolio: what does a world look like where the US president's billionaire friend installs his son-in-law as Fed chair, runs quasi-colonial resource grabs in Greenland and Ukraine, and the independent central bank becomes another tool of executive power? Is that a world where you want 100% of your savings in dollar-denominated assets? In treasury bonds backed by a government running wartime deficits during peacetime? In a currency managed by a guy whose father-in-law is literally buying Greenland? The seizure of Russian reserves in 2022 was the first wound to dollar credibility. The Greenland play, threatening a NATO ally for its territory, was the follow-up. And every sovereign wealth fund, every family office, every central bank from Singapore to Saudi Arabia is drawing the same conclusion. You need gold. Not because of any one president or Fed chair, but because this is what governments do. They always have, from Rome to the Romanovs to right now. Gold isn't about Trump. It isn't about Warsh. It's about human nature and the nature of power. Every government eventually debases its currency. The only question is the speed and the scale. And right now, the speed is accelerating. And one more thing before we wrap up, because I always get this objection. Well, if gold prices are this high, won't they just mine more and crash the price? Short answer, no, it doesn't work like that. S&P Global data, not a single major gold discovery in the last decade has cracked the top 30 all time. The average new discovery is getting smaller, 4.4 million ounces versus 7.7 million the decade before. And even when you find gold, the average time from discovery to production is now 18 years. In the US, it's 19. Compare that to 6 years in the 1990s. You can't just turn on a gold faucet. The supply response to higher prices is measured in decades, not quarters. This is a structural tailwind for gold prices that most people completely ignore. So to summarize, the crash was mechanical, not fundamental. The new Fed chair is not the hawk the market thinks he is. The real drivers of gold, fiscal insanity, eroding trust in dollar assets, the weaponization of the financial system, haven't changed one bit. And the supply constraints make it nearly impossible for new mining to meet demand. For long-term investors, this kind of panic selling without fundamental cause, that's not a disaster, that's a sale. That's it for today. Good luck investing, and take care of your loved ones. See you in the next one.